There are three exogenous shocks that are impacting the U.S. economy. Number one is the eurozone crisis. What's going to happen to Greece? Will there be an exit of Greece? What is the contagion in Spain? What is the contagion to Italy? And what is the reaction by European policymakers? That's a key concern for U.S. investors, and it will impact the U.S. economy. The second biggest concern is China. China now is the second largest economy of the world. The U.S., the Americas region, we export a lot to China. So a significant slowdown in the Chinese economy is a second shock that can impact our region in the Americas. And finally, what's happening in the United States. The United States may be facing a fiscal cliff. This is a combination of taxes and budget cuts, austerity measures that, if it's allowed to pass, will definitely take away from our GDP growth in 2013, and it accounts for the third shock that may impact the Americas region. The outlook for growth across the Americas is bifurcated. If you look at the US and Canada, probably 2.5% modest growth, and we expect the same type of growth in 2013. Where the more dynamic growth is going to be is in the emerging markets across Latin America. Brazil is going to do much better. We think that Brazil is going to grow probably twice as fast as the United States. There's a lot of foreign direct investment coming into Brazil. They're going to have the World Cup that they're preparing for in 2014. So that's one market that's going to exceed growth rates across the Americas. And then there's Mexico. Mexico hadn't done very well. It's really tied to the US. So when the US went into a downturn, Mexico really suffered. But I think with the growth in the US, the Mexican economy is doing very well, and we're much more optimistic about the trajectory of growth over the next 2 years for Mexico, probably around the 3 to 3.5%. Market volatility, there has been an expectation that there may be another round of QE3 by the Fed. Having said that, I think what's happened in the bond market with 10-year yields at some of the lowest that we've ever seen in history has already caused its own form of QE3. I do think that with the poor payroll data that came out last week and some subsequent data on retail sales that have not been very strong, I think there's a high probability that the Fed will do another QE3 in the form of Operation Twist, which is basically they won't change the size of the Fed balance sheet, but they will sell short-term securities for longer-term maturities in order to lower the longer-term interest rates, which its effect is going to be lower mortgage rates to really kickstart housing. If there is QE3 and interest rates continue to decline, it's positive for real estate. Commercial real estate is a capital-intensive asset, so lower yields does improve both in terms of acquisition or underwriting capability, and it makes it a much more appealing investment. If interest rates are low, then the spread to current cap rates, which on average can be anywhere from 5 to 6.5%, makes commercial real estate very attractive. If there is no QE3, real estate will be attractive, but maybe not as attractive as had we had QE3, because even in this current environment, yields are very low. Benchmark yields are still very low.
Well, the European economy clearly has experienced quite a sharp slowdown over the past 12 months or so, and indeed some economies, particularly in Southern Europe, are now in recession, and some have been there for a while. But even in the stronger economies, which were previously expanding at a reasonable pace, Germany included, have seen signs of quite a sharp slowdown for the eurozone as a whole. Therefore, we're looking at probably negative GDP growth this year, not very much next year. The UK, as we know, has slipped back into, at least technically, a double-dip recession. So these economic trends are feeding through directly into occupier markets, and broadly speaking, the occupier markets in general across Europe are slowing down in line with economic trends. What this has done in those markets, let's say in the office sector, for example, where earlier we had seen signs of recovery, a pickup in net absorption of office space in demand and in rental levels from the low point in 2009. Well, over recent quarters, those trends have slackened, generally running flat, or in some cases, take-up turning down somewhat. And broadly speaking, rents in those markets really moving sideways now. It's typically London, Paris, for example. In other markets which had been badly hit in the downturn, particularly some of those in the periphery economies of Europe, well, the slowing down, where there hadn't been any recovery in the market, the economic slowdown has really put the prospects of recovery probably even further back, and so we're seeing rents there, in some cases still edging down, but certainly not seeing any signs of uplift. So the general trend really is to have taken the momentum, or any recovery momentum in large part, out of a great majority of the markets across Europe. What we're seeing investment markets to some degree respond to the trends we're seeing in occupier markets, so investors becoming more cautious about investment, pursuing generally more risk-adverse strategies, which means more of a concentration onto best quality assets in the strongest markets, much more caution about secondary markets, much more caution clearly about some of the southern periphery economies and those markets considered to be most exposed to sovereign debt risk problems. So capital flows over recent quarters have started to show something of a shift, very much a north-south divide now, with activity reducing in Portugal, Spain, Italy, for example. Well, in the first quarter of this year, those markets were well down in activity terms on a year earlier. And in fact, we saw in the first quarter of the year a strong concentration in terms of total investment turnover on the UK market, benefiting probably from its safe haven status, stronger liquidity, and actually now perhaps also from being outside the euro. Strong activity relative to their size in the Nordic markets also, and 3 of the 4 Nordic markets are also outside the euro, which may be significant. And thirdly, the concentration in Germany, where investors drawn by the perceptions of the stronger economic fundamentals there. And those 3 areas, the UK, Nordics and Germany, together accounted for approaching 80% of activity in the first quarter of the year, which I think is quite a striking illustration of the sorts of impact that the darkening clouds over the eurozone are now having on investment flows. Probably the dominant trend and influence of the eurozone crisis is to push investors towards more cautious strategies, defensive in many cases, and that is being reflected in either a concentration on lower risk assets in general, and or a trend towards avoiding or reducing activity in specific eurozone markets. And some investors are combining both avoidance of some markets and the concentration on lower risk assets. So that's, if you like, at one end of the spectrum, and it's probably the strongest trend we're seeing at the moment. That said, there are some investors in the market who do see the crisis as either actually or potentially creating opportunities, particularly the possibility of acquiring assets at discounted prices in, if you like, distressed situations or through forced sales. and particularly focusing on those markets which they see as having repriced, but which also could have a recovery potential, taking a medium-term view. So there's a spectrum of responses, as I say, which very much reflects the investors' attitude to risks. While the majority are leaning, I think, towards more caution, there is a group with somewhat stronger risk appetite who are seeking out opportunities. The overall outlook for real estate markets in the eurozone now obviously hinges hugely on how the crisis surrounding the euro is going to unfold. Already the eurozone crisis over the past 2 years now, really, in the time that it's been running, has had an increasing impact on markets which are showing the growing imprint, if you like. It's affecting occupational markets in terms of its association with a slowdown in activity and in property demand, so rents at best moving sideways. It's affecting the investment market in terms of flows of capital, direction of that, and also now beginning to come through, I think, in some signs of incipient weakness in pricing in general in the market, and particularly pricing in the secondary parts of the market. Broadly speaking, with the euro crisis, it seems unlikely to be reaching any resolution in the near future, and with the potential for it to get considerably worse, then I think we should be expecting that the trends that we've seen over the past 12-18 months gathering pace will continue to do so, and in some respects intensify. So I think we're going to see greater polarization in the market, more differentiation in performance, probably more caution and risk aversion on the part of many investors. I think overall levels of activity, both in occupational markets, will be constrained by the general economic environment, and activity in the investment market constrained by increasing caution, and also constrained by this severe shortage of debt finance for property investment. Now, precisely how intense those trends become, and indeed how adverse they become ultimately, does very much depend on how the euro crisis is going to unfold. Is it going to splutter and stagger and lurch on with repeated financial stress, but with the euro holding together, but not breaking apart, which would be a sort of continuation of the muddling through scenario we've seen now for the past 2 years? Or is there going to be now some serious fracture? And it is impossible to predict with any degree of confidence presently what might unfold if you did have one or more exits from the eurozone. It's that uncertainty in itself at the moment which is perhaps overall the most dominant effect of the crisis on the market, because such a high level of uncertainty is a major depressant of sentiment. It tends to block decisions or cause investment decisions to be put off, and this is a key feature we're seeing in the market at the moment, of this slowdown, taking much longer to complete transactions, a loss of momentum, general inertia.
Well, I think from an economic point of view, and it all stems from the economy, very important to understand that Asia has not decoupled. Asia is still very much dependent on what's going on elsewhere in the world, still very much subject to what we're seeing happening in economies, particularly North America, and particularly Europe, which is probably Asia's biggest trading partner. So from that point of view, the Asia-Pacific economies are still showing good growth. I mean, they're still showing positive growth, which not everywhere is, and actually they're seeing quite strong levels of economic activity, lower than we saw last year generally, and lower than expectations had been because of the current nervousness and the current slowdown, but still pretty positive. So Asia Asia-Pacific is the economic bright spot in the global economy. From an occupier market point of view, it does depend a bit on which markets and which sectors you're looking at, but Retail activity still generally pretty strong. We're seeing a strong emerging middle class, more affluence, strong desire for particularly for Western brands. So we're seeing strong demand from retailers generally. In the industrial space, a lot of companies reconfiguring their logistics, strong demand for good modern logistics facilities, and also companies still establishing and shifting around their manufacturing facilities. So that remains quite healthy. From an office point of view, here really you've got two stories. On the one hand, you've got Western multinationals who've got a lot of their business activity is focused in or takes place in North America and Europe, and of course they're quite concerned. They're being quite cautious about making big decisions. So they're not doing nothing, but they're just trying to hold off making big decisions for as long as they can or until they have to. From a domestic point of view, Asian companies that are more focused within country or just in the markets within the region, again, they haven't decoupled from what's happening in the rest of the world, but generally because of that stronger growth that we're seeing in the region, they're being much more aggressive, much more feeding off the internal economy within Asia, and generally they're still continuing to expand and still continuing to take space. So the level of expansion in the market has definitely slowed across all sectors. Rental growth has just moderated from what we were seeing in 2010, early 2011. A slowdown driven by what's happening elsewhere in the world, but certainly more positive than we're seeing in most other regions. I think from an investment point of view, similar to what we're seeing in the occupier markets, we're definitely seeing an impact coming through from what's going on in the rest of the world. Just as rents are slowing demand and the demand outlook is slowing a little bit, that's hitting expectations at least of short-term growth in Asia, which is making investors a bit more cautious. Also, what we're seeing is investors really very much concerned about risk at the moment. They're worried about what's going to happen in the wider investment markets. So around the world we're seeing government bond yields and safe haven assets trading at very high prices and very low yields, and real estate's no different. Real estate's actually a very good each way bet in the current environment. On the one hand, it's very good defensive characteristics because it's a real asset. You've got a good secure income flow and generally a pretty high income return. Equally, if and when we do see a recovery, if we see demand starting to come back and rents moving, then you'll get the benefit of that. So investors are still very keen to invest into the very best real estate, but the very bullish investor sentiment that we saw coming back into the market even during 2010 has just moderated a little bit. That said, there's no shortage at all of capital in Asia. There is still a shortage of product of better quality investments that people want to buy. There is more money in the market than there is product available. So although the level of transactions has moderated a bit and sentiment's not quite as bullish, still we're very much seeing strong interest in the better quality assets that do come to the market, and pricing is pretty tight and looks pretty aggressive from a sort of more Western institutional investor type perspective. But still a huge amount of interest in the market and still a lot of money. The market's slowed again, but a lot of money going into China, a lot of people looking at Tokyo. Clearly the Chinese economy is a major issue for everybody in Asia. It's a global issue now, but it's a major issue for everybody in Asia. And there's no question that the Chinese economy is slowing. That was deliberate. I mean, the Chinese government was quite explicit in saying that the rate of growth that they were seeing needed to moderate. Certainly some of the asset price inflation that we were seeing, particularly in the residential market, but also in the commercial markets, had got to a very uncomfortable level. House prices need to be kept at an affordable level for the general population, and the sort of activity that we were seeing in some markets and the price increases that we were seeing was something that the government very definitely wanted to cool. The big question is, how does the Chinese government rebalance its economy? How does it achieve a managed slowdown, a soft landing, rather than an uncontrolled decline? And that's going to be difficult. but we certainly think achievable, that the Chinese government has some somewhat crude but actually pretty effective levers at its hands in order to control the economy. The level of activity is now definitely slowing. We're seeing that coming through in the construction markets in particular, because construction is a big aspect of the market. We think that we're now at a point where the Chinese government is going to start reintroducing stimulus in different ways. It's not going to go back to what it did in 2008, 2009, but at the moment that's not necessary. And they certainly don't want to start refueling a construction and speculative property investment boom. So I think that actually the stimulus that they're going to be putting in is perhaps going to be elsewhere, maybe back into looking at some more infrastructure projects. But there are definitely signs that the government is now looking to start just stimulating domestic demand, domestic consumption. Overall, on balance, our view is that whilst there may be some concerns still about the balance of the economy, and there may be some challenges and issues that the Chinese government faces in the years ahead, right now the government knows that it cannot afford a hard landing, it cannot afford a slowdown given the fragility of the global economy. From what we're able to gather, and it's not always easy looking at the statistics and reading exactly what's happening in the Chinese economy, but certainly our belief is that they have the firepower, the financial firepower, and they have the ability to make sure that the slowdown is managed and that the economy remains in reasonably robust shape. I think if we look slightly further ahead in terms of beyond the short term and the immediate crisis, which we'd all like to get past from here, there's no question that our view is that Asia, of the global regions, Asia is likely to benefit first, it's likely to benefit most, and it's likely to benefit longest from any recovery in the global economy, and that will feed through into occupational demand growth and stronger investor sentiment. There seems no question that over the next 10 years or so, at least, Asia is likely to be the primary driver of growth in the global economy. The Pacific Australian economy in particular is benefiting from that. So are the key trading hubs and key trading centres: Singapore, Hong Kong, Seoul, Tokyo, and the major Chinese cities. So the market is far from dead at the moment, and the economies are still showing reasonably robust growth. But as we start seeing more demand coming through, as we start seeing a recovery in the global economy, the current stash of cash that American companies and many Western multinationals are holding in case something goes wrong, in case there is a big crisis, once we start getting past the crisis period, that cash needs to be put to work. And we're firmly of the view that much of that money will start looking at opportunities, corporate investment opportunities into Asia to take advantage of that economic growth. Corporate money will flow. We're likely to see more merger and acquisition type activity. And as growth regains momentum, then we will start seeing investment capital flowing. Very difficult to invest just into standing investments, but as that demand comes through, we'll see money going into development activity, looking to take advantage of that growth. So Asia certainly hasn't decoupled, still very much subject to what's going on in the rest of the world, but equally, once the rest of the world starts coming out of intensive care and showing signs of life and signs of health again, certainly we think the opportunities for Asia and the Pacific region are very, very positive. In terms of where we're seeing the strongest interest at the moment, it's pretty clear. China remains the biggest long-term strategic bet, and China retail in particular for real estate is something that we're seeing a huge amount of interest in. As ever in China, not easy to find the right assets to buy, but that's definitely the top pick in the whole of the region. Strong interest in Tokyo, in Japan generally, quite a lot in Japanese industrial, but also in Tokyo offices, because even though prices are quite keen, debt is readily available at very, very low cost, so there's a good spread there. And finally, Australia. Yields are relatively high in a global context. You can go in and buy good quality assets. The only issue that we're looking at the moment is that there's been some recent changes in the tax legislation, which may actually make it harder for international investors to access the market. And we're just working through what the implications of that are at the moment. But Notwithstanding that, the Australian economy looks relatively robust in a global context. So we're seeing strong international investment interest still there. But the truth is, such are the prospects for the Asian economies and the Asian markets that, to be honest, pretty much anywhere in the region, if you've got good product available, we're certainly seeing very strong interest coming through from domestic and international investors, and we expect that to remain the case for a while.